Good morning, everybody here in the room and on the West Coast. Good afternoon, everybody else. This is me, Lewis Sharpstone, and the most important information on this slide, perhaps, is my contact information. I've given you my office number, my cell number actually, and my email address. I'm a partner in the non-profit practice group with BDO. And my job here today is to give you the information that you've signed up for as advertised. And it may well be that you have follow-up questions. And if you do, I would invite you to email me after the session. I'll do my best to help you. I'd like to be as helpful as possible. And if you happen to ask me anything particularly tough, I might refer it to somebody else. Or if you happen to be close by another BDO office, as you can see, we have a little over 60 offices in all parts of the country, and it may well be that wherever you are, you're close by another BDO office. I'd be more than happy to refer you to those folks to be able to help you as well. The materials I've included in my materials, a lot of slides, and my overall style when I present is to try and be to provide my slides as a resource. So my goal was to provide something which is going to be helpful in the next months, possibly even years, in order to help you implement some of these new upcoming accounting pronouncements. And we have a very broad group, both here in the room, but also on the internet, on the web, and all different kinds, from CFOs to controllers to other people. So this might be materials that you can hand to somebody else within your organization to help you implement as well. So I hope the materials are useful. Just I've included a few bits about BDO, and I'm going to skip over the information about BDO. We've had a fairly good marketing campaign of late, people who know BDO, and but if you don't happen to know BDO, it's a wonderful firm with incredible culture and values and so on, and I just put that up there. And we serve nearly 3,000 non-profit organizations around the country, so lots and lots of experience. And so now we're going to be talking about, the title of my talk was Navigating the Upcoming Non-Profit Accounting Pronouncement Tsunami. And I've included on this slide a different word, not tsunami, but trifecta. And I want to talk about that for a moment, because I'm primarily going to be covering three accounting pronouncements. The one regarding the non-profit presentation of financial statements, that's called ASU 2016-14. The one on revenue recognition, that's commonly referred to as 606, we'll get to that in a moment. And then leases. And trifecta was a word came up with one of my partners, Lee Klump. And I like that, and I'll tell you why. Because a tsunami, there's nothing good about a tsunami, right? That is always bad news. But as we're going to get into in this hour, I actually think that these accounting pronouncements are terrific. I think it's really good. And I think that trifecta is generally, if you're a recipient of a trifecta, that's generally good news. And so I like that word trifecta. The other thing that occurred to me as I was struggling with this odd word, tsunami versus trifecta, is a tsunami is something that kind of happens to you. You really have no control. You're kind of a little bit, if you like, of a victim of it. And a trifecta is something you actively have to participate in. So at this juncture, I just want to make this point. And by the way, I'm going to be giving you a lot of fact. I'm going to be giving you some opinions. The opinions are mine. They don't necessarily reflect BDOs or other accounting professionals, although maybe they should. But I just want to state this opinion because it appears sometimes when we're dealing with these accounting pronouncements that they are somehow thrust on us from up on high, and we have to comply with these things, and we're all wondering why, and it doesn't feel as if we had any say in the matter. But I want to assure you that the exact opposite is actually occurring. And 20 years ago, I felt that FASB was not consultative. FASB is the Financial Accounting Standards Board that put these pronouncements on us, as many of you know. I had this impression that they were not consultative and they thrust things down on us, but that was because I didn't really understand the process. And now I understand it. I see that they're extremely consultative. They are responding to the stakeholders and getting a great deal of input. And in fact, with the first one, I was actually part of that input. I was invited to attend a roundtable of FASB in 2015 when they issued the exposure draft before they actually went final with this accounting pronouncement. And they really did. It was a fantastic experience, by the way. I really enjoyed it. And they really are listening, and with all of these things. And so what I'd like to encourage everybody to do is to start to embrace these things. And I thought I would start with the financial statements of non-profit entities and start with this, because BDO has a non-profit blog and a newsletter, and there's a lot of people that subscribe to it. And we had a survey, and the survey said, a bit like Family Feud, survey says, have you had a chance to review the new standard yet? And this was a relatively recent standard, and 61% said yes, and 39% said no. Of course, if we had that survey of everyone on the web, it's 100% yes, because we're reviewing it now. But here's the next question. Do you have a plan in place to implement the updated accounting standard? And only 27% said yes, and 73% said no. And my call to action and my encouragement is to encourage every non-profit to, at least by the end of 2017, even though these things don't need to be implemented for a while. And actually, I'm going to go back to a previous slide and cover the implementation of this. The reason it's the tsunami analogy is because there are waves coming, one and then the next and the next. But I would strongly encourage every organization by the end of this year at least to have the plan in place to implement this financial statement accounting standard. And the reason is that many of you are going to have boards that maybe sit on other non-profits, and you may get a question at an audit committee meeting or a finance committee meeting. What are we doing to implement this standard? How is this going to affect us? And it's going to look pretty bad on you if you don't already have the answer. And I also want to point out this survey, which was the next question. Do you plan to pursue early adoption of the changes laid out in the ASU? And interestingly enough, 24% said yes. So of the 27% that have a plan in place to implement the accounting standards, 24% said they were looking to adopt it early. So that tells you right there that the recommendations within the standard are being very positively received. And so that's another reason why I would strongly encourage you to, for those of you that don't have the plan in place, to get the plan in place to implement the standards. Let me just, I'm going to flick back to a slide just where we talk about this, because the effective dates, just to understand when these things kick in. So for the first one, the financial statement presentation, this is for fiscal years. They always say beginning after 12/15/2017. So it would start for, if you're a calendar year end, that would start January 1, 18. So this is for your December 31, 18 year end, or if you're a June year end, this will be June 30th, 19. And then the revenue recognition one, the next one, is the very next year, except if you happen to have conduit debt, public debt, in which case you have to adopt a year early. And then the leases is the very next year after that. For example, so leases is fiscal years beginning after December 15, 90. So this will be, if you're a December year end, this will be January 1, 20 implementation. So the year ended December 31, 20, or June 30th, 2021, which I know sounds like the distant future, but boy, the years roll by, don't they? And it all clips in very quickly. And by the way, with the leases, I actually saw my first financial statement that did actually early adopt the lease standards, and they had a specific positive reason for early adopting, and it worked out very well for them. So with all of these things, one of my headlines, just to repeat myself, is encourage you very strongly this year to have a plan in place to implement these standards, even if you're not going to do it for a while. So at least you are prepared if you get the questions and so on. So I'm going to move on to slide 15. So this is with the financial standards, ASU 2016-14. The overall objective was an update, not an overhaul of the current model. Because those of you that have been doing this for quite a while, and I've been doing this now here in America for 30 years, I'm old enough to remember in the mid-90s when we adopted FAS 116 and 117, which was a brand new model for non-profit financial statements. And so after 20 years of going with the current model, the idea was for the NAC, which is the Non-Profit Advisory Committee of FASB. There is a Non-Profit Advisory Committee of FASB that makes recommendations to FASB. They came forward and said, okay, it's time to see if we like our financial statement model and should we be tweaking it. And so these recommendations, again, bubbled up. It's all a variety of stakeholders within the nonprofit community. And they decided, overall, we're not going to completely overhaul the model, but we're going to update it. And there were certain problems identified, and these identified problems or issues have been corrected and improved. And as we're going to see, it relates to the net asset classification scheme. There will be improved information about financial performance, cash flows, liquidity, and the overall goal is to better enable nonprofits to tell their financial story. So there is some flexibility involved in all of this, and that's the goal. And I think that's why most of the folks that have understood the standards are really liking it. So just to click ahead to net assets, let me just get to this slide here, because we're all, I think, familiar with the current format of the net assets: unrestricted, temporarily restricted, and permanently restricted. So under the new standard, we are going to two categories of net assets without donor restrictions and with donor restrictions. So we are committing temporarily restricted and permanently restricted net assets to the history books. And it's interesting because when this whole concept, I think everybody really did understand permanently restricted net assets, that's endowment funds, and unrestricted net assets, we know that. Temporarily restricted, I don't think, we all understood it, but we didn't really warm to it. And one of the main drivers of moving to this, merging the temporarily restricted and the permanently restricted, there were a few drivers. One was the understandability to the stakeholders. People understand donor restricted and unrestricted. But secondarily, those nonprofits that had endowment funds, that had money within permanently restricted, under the old definition of how, under the old rules under which endowment funds were managed, which used to be called UMIFA, the Universal Management of Institutional Funds Act. That was the old rules for managing endowments. This model seemed to work. But in 2009, I think in 2009 and 10, UMIFA became UPMIFA. Many of you know that. They added the P for prudent, the Uniform Prudent Management of Institutional Funds Act. And what that said, in the old rules, you had to maintain the original corpus. And I see some of you in the room are nodding, and that's great, and you all know that. And under the new rules, you are required to maintain the purchasing power of the endowment. Under the old rules, you could never legally dip into the corpus, but under the new rules, so long as you maintain a plan, a pretty solid plan to maintain the purchasing power of the endowment, and you do that by setting an investment policy and also a spend policy. And as long as those policies are pursued to maintain the purchasing power of the endowment, you were allowed, if the endowment due to investment losses in a particular year dipped below the original corpus, you were still allowed to make your under the new rules, you're allowed to make your draw. And this created a lot of problems within the current model of permanently restricted and temporarily restricted, and those problems have been eliminated by this overhaul. So again, I'd like to say this was all very encouraging. And particularly with underwater endowments, what I just referred to, that was really the issue, because under the old model, if you had an underwater endowment which had dipped below its original corpus, the only way the accounting rules could work was that the underwater element would be reflected in unrestricted. But now, under the new rules, the underwater piece will be reflected in net assets with donor restrictions. So it goes, so the underwater piece goes into the donor restricted part, not the unrestricted part. And that, to me, under the new rules, makes a lot of sense. And that might be a driver for some people to early adopt. So again, another reason to think about these things, make the effort to understand this accounting pronouncement this year. There's another nice cleanup within the new guidance, which talks about gifts restricted for acquisition of construction of property and equipment, whereby you, under the old rules, if you, for example, did a capital campaign, you bought a building, you didn't raise all the money, so you had to borrow some money, but you also raised pledges which were going to be paid in the future that will pay off that loan. As you know, fixed assets are unrestricted, the loan is unrestricted, but you had those pledges to cover that loan, but those pledges were sitting, or could be sitting, in temporarily restricted. There was an option, but not too many people seem to know about that option, to actually treat those pledges. Normally pledges, as you know, are temporarily restricted because of the time restriction. There was an option to treat those as unrestricted, but people didn't really, I think, understand the option or take advantage of it, so to speak. And now they have clarified that and said, okay, you're now required to use the place in service approach, and there's no more time restriction for those kind of pledges. Again, another example of cleaning things up here. With respect to liquidity, liquidity within non-profits is somewhat confusing. Some non-profits can have nice, substantial balance sheets which show cash and investments and all kinds of things, but because of permanently restricted endowment funds and other funds which are restricted by donors for certain projects and so on, it may well be that a non-profit doesn't have, it might look wealthy, but it's not actually wealthy. It doesn't have the financial resources now. And it's been hard in the past for the non-profit to make its case, or some non-profits to make their case that they actually do need unrestricted contributions when their balance sheets actually look relatively healthy at first glimpse. So the new standards requires a lot more disclosure with respect to liquidity and availability, and it requires both qualitative information, and which is a description of how a non-profit manages its liquid resources, and also quantitative, which means tables and numbers and so on. And in these materials I've included a few examples, again, to be useful for you or anybody you want to give this to as a resource. So next, some non-profits, in presenting their statement of activities, present an operating measure. That's equivalent, if you like, profit or increase or decrease in net asset from operations, because as you all know, non-profits have operational revenues and expenses, but then there's also other things which are going to affect the net assets which aren't operational. And there was some disparity in the practices, so the accounting pronouncements have trued up and made clear what has to be shown within an operating measure. And there's some very interesting additional guidance, because many non-profits, as you know, have board designations. And those board designations, 20 years ago, honestly, I think there was some sense that board designations weren't too important because boards could always undesignate. But Boards designated funds has continued to be more and more important, and boards take that more and more seriously. These studies have shown that when boards designate, for example, by creating a quasi-endowment, they take that very, very seriously and won't necessarily, even though they have the legal power to undesignate those funds and use them for operations, boards are very reluctant to do that and treat them almost as if they were donor restricted endowments, and that's a great thing. And again, in order for non-profits to tell their story, there is additional guidance with respect to these operating measures and board designations. So with respect to expenses, you may all be familiar with the Form 990. As you know, non-profits have two primary documents that demonstrate accountability to stakeholders. It's the audit and the Form 990. And the Form 990 has that page on it which shows the expenses split between program, administrative, and fundraising. And non-profits have been required to disclose those as well. But only some non-profits, not all, have been required to show the table. And those of you that are in a non-profit that shows the schedule are showing the functional expenses, you're all familiar with that grid, which has the programs on the top, and then administrative and fundraising, and then down the side it's got all of the different expenses, the salaries and utilities and so on, and it's all done out in a table. And it's often got a bit more information than the Form 990, but some non-profits, for example, the 501c6s, didn't have to produce that within their financial statements, and certain other non-profits, certain arts organizations and voluntary health and welfare always did, but if you're not a voluntary health and welfare organization, maybe you didn't have to put that in your audit, but it was in the 990 for some of them. So I'm happy to say that the new guidance is making it such that that table goes in all financial statements now. And I'm happy about that because it increases the usefulness of the audit, and for many non-profits that information is already in the 990. And so that's the expense reporting change. And there is a small change with respect to investment returns. There has been inconsistent application of how you present the investment returns in a financial statement, and it's been clarified now that the investment returns, particularly with the return, the expenses are netted against the return, and it goes on to clarify what is included within your expenses, which is external and direct internal expenses. And the internal ones are sometimes forgotten, but it actually does affect the overall investment return, and they won't be forgotten any longer. And so on the cash flow statement, this was fairly interesting because, as you know, under current GAAP, non-profits and for-profits have a choice between what's called the direct and the indirect method. And there was a lot of debate, and I remember that debate within FASB as to whether to require non-profits to do the direct method, because generally the consensus, by the way, just so that you know, the consensus within the non-profit community is that the direct method provides more useful information to the stakeholders than the indirect method. I'm just telling you that for your benefit, because many of you are going to do it in the indirect method. But by the way, if you do the direct method under current GAAP, you're required to do this indirect reconciliation, which is a reconciliation which reconciles the accrual basis net income to the cash flows from operations. So if you do the direct, you have to do this indirect reconciliation. And under this new accounting pronouncement, you can still choose either. They left that in, but you no longer are required to provide the indirect reconciliation. Now again, it's just my personal opinion. I find that indirect reconciliation actually quite useful, especially if you have a situation where a non-profit organization maybe has accrual basis income from operations, but the cash has gone down, or the other way round. You've got a loss, but the cash has gone up. For some boards, they want an explanation as to why. You can still provide them the explanation. You can still provide that reconciliation, even if it's not in the audit. So I still think it's a valuable thing to do for many non-profits, but the consensus is it doesn't provide additional information to stakeholders, so it's being left out more and more. And so you've been given the option. Well, it's not being left out right now. The direct is going more and more, and it's making it easier by eliminating the indirect reconciliation. And so with respect to the effective date and early adoption, there are some early adoption is permitted. However, you can implement some of the provisions already, but for you must apply certain transition provisions, and in particular, if you do apply some of the transition provisions, some of the changes, you can't adopt some of them unless you adopt them all. And here are 4 things. You can't just choose to present one class of restricted net assets instead of the 2 without fully adopting the whole pronouncement and everything else. Similarly, the underwater endowment accounting, the elimination of the investment return components, and also the indirect reconciliation. You have to adopt it all in order to get these benefits. Now, we're not quite done yet, because interestingly, in the original exposure draft, there was a bunch of things proposed. And again, I'm really, really proud of FASB taking this approach, where they identified a bunch of things, probably about 2/3 or 3/4 of the things where there was broad consensus and agreement. And they went ahead and issued ASU 2016-14 to include the things we can all agree on in the accounting pronouncement. And then what they've done is all the things that need a little bit more work and flushing out, they've put off to the side, and the project is continuing. And hopefully, I'm not sure when that is going to be, but there will be, the phase 2 project will carry on more to talk about operating measures and whether to actually require intermediate operating measures, and on the statement of cash flows to realign certain items. And there's a small thing which people couldn't agree on with respect to healthcare entities. So I thought that was a very good approach. And again, another piece of evidence, if you will, that FASB is listening to stakeholders. It's all very positive. So real quickly, because I want to move on to other things, but here in your notes, BDO has a tool which we use for our clients, and so to help them with the implementation. But I've included some pages from the implementation tool, but actually these are straight out of the FASB pronouncement as well. So this is the example statement of financial position, showing down at the bottom without donor restrictions and with donor restrictions. And the highlighted portions are the required lines. The rest, as you know, is open for you to present it in the best way possible for your organization. With respect to the statement of activities, they've maintained the 2 formats. As you know, you can do this layered format for net assets without donor restrictions and net assets with donor restrictions. That is carried on from the past. Or there's the columnar format. I mean, I'm personally a fan of the columnar format. You see this more commonly, but it enables you the option to do each. The net asset disclosure, this is interesting because this will come down to the net assets with donor restrictions and split it up into its various components, subject to expenditure for specific purposes. So that may be the old temporarily restricted, but also subject to the passage of time. There is other spending policy and appropriation. That might be the endowment funds. and then down the bottom there are other things. So it provides a lot of information, but all within the net asset with donor restriction classification. This is interesting. I'm not going to go through this, but I included for your package a sample disclosure on the quantitative and qualitative liquidity and availability of resources footnote, because a lot of people are struggling. Well, what do we put in? So right there in the FASB put in an example, and I've included it in your materials as well. So it's not obviously, you're going to write it as it works for you, but it's a good starting point here. And this is the quantitative disclosure showing that this example nonprofit had financial assets at the year end of 234. This will be, let's say, million, not thousands, of course, because it's in thousands. But at the end of the day, it comes down to financial assets available to meet cash needs for general expenditures within 1 year was 5,370,000. So a very different picture. And again, this is useful for stakeholders to know that this nonprofit actually still needs your donations. And so this is an example of an operating measure disclosure as well, just to be helpful. So, and also I included the indirect method and the direct method in the statement of cash flows, just because if there was anybody that wasn't exactly sure, you always do it one way and you're not sure what the other way looks like. So I've included that as well for you all. The AICPA has a very good resource as well. They've got on their website a standard example financial statement called Save Our Charities, and you can go on the AICPA website and pull this up and see this too. Again, that's all guidance for you. So, moving on to the second topic, revenue recognition from contracts with a customer. This is also called topic 606. This is the second element of the, if you like, Tsunami or trifecta. And so this was a huge project undertaken by FASB, and the goal was to develop a single principle-based revenue standard for US GAAP and to try and conform it as much as possible, and they did exactly, to IFRS, the International Financial Reporting Standards. By the way, US GAAP is not dead. I'm going to talk about that in the next section, and I'm personally, again, my opinion, very happy about that. But this revenue standards was aiming, because US GAAP provided a lot of different revenue standards for different industries. Obviously, non-profits had its revenue recognition standards, and oil and gas had its, and the motion picture industry had its revenue recognition standards. And the idea was can we come up with a framework to encompass revenue recognition standards for all contracts with customers? And it was a huge project, and it has been achieved. And it has provided the framework. Non-profits are not exempt from this revenue recognition standard. And so it applies to all contracts with customers, but it doesn't apply to lease contracts because that's covered by separate GAAP and certain other things. But it also does not apply to contributions. That's the good news here. So as far as non-profits, as you know, under the current GAAP, non-profits have contributions, and then we have exchange transactions. We do have contracts with customers, we do. And this applies to those, but does not apply to contributions. They were scoped out. And in short, for most non-profits, this is going to be a documentation exercise. This will affect the accounting for some non-profits fairly substantially, and it's important to understand this. But for many, it's going to be a documentation exercise, and this is what I'm going to go over. GAAP requires a 5-step process to apply this new revenue recognition standard. So any non-profits that have a contract with a customer, this can be with members or with the federal government and so on, we're going to talk about that in a moment, you have to apply this 5-step principle, which is step 1, identify the contract with the customer. 2, identify the performance obligations. 3, determine the overall transaction price. By the way, the performance obligations, obviously what you have to do under that contract, which because often a contract is going to involve multiple things that you have to deliver. If you think about your contracts, you know, certainly like federal contracts and so on, think about the multiple things that you have to deliver. You have to identify all those performance obligations. So 3, the transaction price. 4, then you have to allocate the transaction price to those performance obligations. And then 5, you recognize the revenue as and when you satisfy those performance obligations. So that all makes sense in a kind of a generic sense, and we'll just get into this a little bit more. So step 1, this is the easy one, identify the contract with the customer. And when you get into it a little bit, I've simplified these slides. The GAAP itself is relatively complex, but I think it can be made relatively straightforward for most non-profits. You will be required to at least identify the contract elements, or identify the contract, and there has to be 6 elements normally, and you can combine things, but we can skip over step 1. Step 2 is you have to identify the performance obligations, and that might be multiple things. This is best worked with an example, and I've got 3 examples. I'm going to go through those very quickly in a moment. Step 3 is you determine the transaction price. That is normally going to be, of course, the amount expected to be received. It could consist of fixed and variable amounts, so that's going to create an additional wrinkle. It may possibly include some non-cash contributions, such as in-kind and so on. And you may need to adjust if there's a significant financing component. These are additional wrinkles that may affect you. Step 4 is you will wind up allocating the transaction price in a systematic manner to each performance obligation. And then step 5 is recognizing the revenue as the performance obligation is satisfied. And I find this is best understood by way of an example. And so we'll go through, this is a slide with a disclosure. For public companies, which can include non-profits, if you have tax-exempt bonds or non-conduit debt, there is a tremendous amount of disclosure on this. By the way, we haven't found any non-profits early adopting this. So I don't recommend, unlike the other financial statement model, you may not want to even consider early adopting it, but it's still good to at least understand what's going on. It's thought that there might be as much as 4 or 5 pages of additional disclosure for non-profits with that fall under the public domain. For other non-profits, it's going to be a lot less, fortunately, but it's still going to be some. So these are the potential application considerations for non-profits, which includes contributions, membership dues, licenses and royalties, and government grants and contracts. That's the big, I'm going to say, like, elephant in the room. We're going to talk about that because we're still working out how this applies to government contracts, trying to get it out of this. And again, I'm proud of the regulators for trying to work through this now. So let's, when it comes to bifurcation, you can have a contract which is partly a contribution and partly a contract with a customer, or the old exchange transaction. And there is some very good guidance within GAAP right now that helps you with this bifurcation to figure out if you have a contract, some of it might be contribution, some of it might be a contract with a customer, and this guidance, this table, helps you sort through what elements of each you have. So let's just, a few simple examples. And I just chose membership dues just to make an easy example. So in this particular example, a nonprofit has annual dues of $160. Members receive a benefit from their dues to sign up for networking events, but they have to pay for those. Sign up for webinars and have to pay for those. They have to pay for everything they sign up for, but it gives you access to these. But you also get a monthly newsletter, and the fair value is $50 annually. So now you have to apply the new RevRec standards for this. And you will go through the 5-step process. Step 1, identify the contract. we know what it is. That's the contract is to provide members the ability to subscribe and also the monthly newsletter. The performance obligations are the general membership services, but also the newsletter. Determine the transaction price, easy, $160. Step 4 is you have to allocate now the transaction price to the performance obligation. So that will be $50 for the subscription revenue for the newsletters, and then the remaining $110 to the membership service revenue. And then step 5 is you recognize those things as the performance obligation is satisfied. So in both these cases, both the membership benefits are provided each month, so they're allocated each month, and then the newsletter is a monthly newsletter, so they're allocated each month, so it gets allocated, the revenue gets recognized each month. Now with example 2, it's a little bit different, $150 of dues, except that there is a monthly newsletter of $50, and that's it, nothing else. Well, the fair value is $50. So in this particular case, this is where the amount paid for the newsletter, $50, is a contract with a customer. And that's reciprocal. But the remaining $100, there's no additional identifiable benefits provided. So the $100 is a contribution. By the way, we're used to doing this with fundraising events, aren't we? Where there's a portion which is benefit received by the donor and a portion of it which is a contribution. And then step 3, you identify the transaction price, allocate the transaction price to the performance obligation, and recognize the revenue. So the $50 is recognized as revenue over the 12 months, but the $100 is recognized as contribution revenue as received. So that's a bifurcation. But step 3 is the interesting one, because I just used an example of a lifetime membership, because some alumni associations, for example, you can pay an amount like $1,000 and you become a lifetime member of an alumni association. And I would tell you, based on my experience, because I work with some, most alumni associations recognize that $1,000 upfront as the revenue. And the reason is they say, well, they have to pay for everything that they're going to get anyway, and it hardly costs us anything to provide that additional newsletter. Therefore, we're going to recognize the whole $1,000 up front. Well, under the new standard, you can no longer do this, because you have to identify the contract, which is the same as in one, the dues for the membership benefits, but also the newsletter. And then when you go through step 2, 3, 4, and 5, you wind up having to recognize that $1,000 over the life of the donor, because the benefit that are the lifetime member. Because the benefit that you have to look at it now, the revenue, you look at it from the outside looking in. And the benefit that the lifetime member gets in year 1 is the same as in year 5 and the same as in year 20. So the revenue has to be recognized on that basis. And so we're going to see some non-profits that have recognized all that revenue and it's sitting there within their net assets, have to reclass a bunch of their net assets out to a liability, deferred revenue, and then recognize those over the life of the lifetime donor. So there's kind of a real life example how this may change. Again, I think this is positive, because financial statements are supposed to, at the end of the day, reflect the view of the organization from the outside looking in and not from the inside looking out. And under the previous way, it was reflected based on what the non-profit kind of thought the costs might be, which were negligible. But here, this is the value to the third party. And I think that, again, conceptually, this is the right way to look at it. This is for the public interest. So with respect to government contracts, we're struggling with this one. Our profession is struggling. By the way, I've included some guidance which is on the AICPA website to help you with this, because this is for government contracts. Unfortunately, there is some, what the accounting body are trying to do is get government contracts into the contribution realm. Right now, most non-profits, not all, treat them as exchange transactions under the theory that the government is not in the business of providing just a contribution to a non-profit without getting anything back. Normally what they get back is the satisfaction of an obligation that they have to provide services. But that would create quite a lot of problems, and also it would be the same accounting, most likely. However, a lot of additional disclosure. So the issue is, can we move this into government grants and contracts into the contribution realm? And there is a project. FASB are rapidly undertaking a project on this, and probably by the end of this year we'll have some guidance coming out, and there is talk about making government grants a conditional contribution. And again, this all needs to be worked out, but this is another reason not to early adopt this at this point. The recommendation is to sit tight, wait and watch for the guidance to come out on all of this later this year, and this will be useful to you. This is some other information. So these are 7 practical steps for implementing 606, and I've listed them out for you. I think you can safely put these on the shelf, as I said, because I'm not expecting anybody to early adopt, but at least you have this. So if anybody asks, you have an ability to talk to them in a meaningful way about why we're not planning to early adopt, but at least you have a plan in place. So I hope this is useful. Leases, one of my favorite topics, I might add. Because, by the way, this is a wonderful resource for you. As you can tell, I'm a big fan of the AICPA. I happen to actually sit on council, the governing body of AICPA. Very, very proud to do that. So I've seen inside, just fantastic. And the AICPA has this thing called the Center for Plain English Accounting, which is not one of those oxymoron kind of things. It's for real. And so I encourage you to, at some point, look up the resources that the AICPA puts out on this. And this was some guidance about implementing the new lease standard. And they have a whole series, and it's on the web and so on. And this talks about why FASB issued the new lease standard, and it talks about over 3 trillion of leasing commitments, for which they don't appear on 85% don't appear on the balance sheet of a non-profit. But my favorite quote is from this gentleman, Sir David Tweedie. Sir David Tweedie was the chair of the IASB, the International Accounting Standards Board. And this is his quote, and this was a speech given 25th of April 2008. "One of my great ambitions before I die is to fly in an aircraft that is on an airline's balance sheet." Which made me think, first of all, accountants do have really kind of a sad bucket lists in a way. Trust me, when I hit 50, that didn't hit my bucket list. But actually, he goes on to explain why that makes actually no sense. Because if you read the rest of this, and you can Google and pull up the whole of the article, it talks about, it is actually an obligation of the airline. It's a lease. As you know, we've always had and continue to have capital leases and operating leases. Capital leases is like financing an asset, and that the asset and the liability goes on the balance sheet. But operating leases, where you're just renting office space and things like that, that has been a disclosure, but not on the balance sheet. And we've been very rules-based here, and so the leases have been written so that many fall under operating leases, and even though they're liabilities and obligations, they don't appear on the balance sheet. And he articulates in this article why, no, this is going to go on the balance sheet. And this was in 2008. And here we are. So that accounting pronouncement ultimately did get passed. So coming in June 30th, 2021, although you can adopt, and there might be reasons to do it. By the way, the one that I saw, which early adopted, they had a slight problem with their debt covenants, but there was it said that the debt covenants would automatically be waived if a violation was as a result of a new accounting pronouncement that you adopted. And so they adopted the accounting pronouncement. They still had the violation, and they were able. It was helpful. Plus, I think it does present more fairly the financial position of a non-profit. And so, so this is under current GAAP, we have capital finance leases, which go on the balance sheet, asset and liability. Operating leases are disclosed. And this is where I was so happy. Under the IASB, the International Accounting Standards Board, all leases are going on the balance sheet. And by the way, this is essentially a grossing up of the balance sheet. At the end of the day, this has minimal effect on the income statement, minimal, but it still has some, but it is grossing up the balance sheet. But under the IASB, and what happens is you put the asset and the liability on the balance sheet, and then on the asset gets amortized to the income statement as an expense, and then as you credit cash, you write the checks, then you pay down that liability, and there's an interest component. So IASB, whether it was previously a capital lease or an operating lease, they're amortizing it to the income expense in the same way. And as you know, the expense on a finance capital lease is higher in the beginning and in the end, because you have interest. A capital lease, you have the interest component, which is higher in the beginning because you owe more money, and the depreciation is normally straight lined. But nevertheless, that leads to what this graph says, that the expense on a finance lease is higher in the beginning and lower in the end, and an operating lease is always straight lined. You know that. So what happened was, FASB came along and said, no, if it was previously an operating lease, you can carry on amortizing it to the expense to the income statement, straight line. And so FASB has taken a different approach than IASB. And I first heard this, I'll tell you when it was. It was October of 2014, and I was at a meeting, and Russ Golden, the chair of FASB, was on the stage and said that they were heading in this direction, and there were 800 people in the room, and I nearly rushed the stage and gave him a hug. I was so happy. And the reason why is twofold. One is he said that, first of all, it meant that US GAAP continues. And I'm all for living in a world community and obviously eventually conforming, but I think that there is a role personally, this is again my own personal opinion, for US GAAP in the world. And so I was just happy for that. And second of all, he actually said on the stage that he was a little bit tired of passing accounting rules that in the past, US would pass accounting rules where the rest of the world didn't follow for a few years later, and it made US companies look worse than the rest of the world. He said, now we're going to do what we think is best for American companies, and this actually helps. It's lower expense in the beginning of a lease under US GAAP than IFRS, and it's good actually for American companies reporting under US GAAP. So I was actually happy for those kind of reasons. But it's also a little bit simpler, and I'm happy for that as well. And so this is basically the lease accounting overview. So for operating leases, there's a new right to use asset and a lease liability. And just to simplify it, this isn't exactly how it's going to work, but just to really super simplify it, if you look at your lease commitment footnote, that's what's going to appear on your balance sheet. But don't take that. You can't. That's an approximation. You still have to go through the proper applying of the standards, because there is some wrinkles to it. So the lease term, if for short-term leases of 12 months or less, you don't have to put those on the balance sheet. And there is, just to bear in mind, there is quite a lot of tweaking of the terms, because the two elements that go into the present value of the lease payment are the lease term and then the lease payments. And you have to look carefully at the new rules. With respect to the lease term, it's the estimated as the non-cancelable period, but it will include periods under option if you reasonably expect to exercise those options. For example, if you've leased space and you put a lot of money into that space, well, chances are you're going to renew the options, and therefore you should recognize it over that period, which might be a higher liability than maybe even your disclosure represents, because under the disclosure it's normally the minimum term, but if you have exercise options, that might be different. Similarly with lease payments, it includes variable payments, but so long as it's tied to an index. And I've had clients which have variable payments which are not tied to an index, and they will be excluded. And for a while, when they were talking about this disclosure draft, they were talking about, I think, including all variable payments, including ones which are really, really hard to estimate. So I'm really pleased that when the first exposure draft came out, there was a lot of complexity. But I'm very happy that they actually tried as much as possible to reduce the complexity. Again, another reason to be proud of our regulating bodies. And so there's some other information with respect to the lease payments, with respect to the lease disclosures. There's quite a lot of lease disclosures with respect to this. It's going to add probably, you've already got some lease disclosures with respect to the operating leases and capital leases, by the way, but it adds still more, including weighted average discount rates and all these other kind of things. So I put those in there for you. And in the guidance, there is some sample disclosures as well. I didn't put them in there in here because they're relatively easy to find. And this is the effective dates, although, as I mentioned, early application is permitted. And also, I mentioned the trifecta, but there are other accounting pronouncements that you at least need to be aware of, and I thought I would be remiss if I didn't at least mention these other accounting pronouncements. For example, those of you that are a non-profit, and there's many, particularly in the low-income housing area, which is a general partner in a, this is guidance, there's guidance just come out as to when to consolidate a for-profit limited partnership or similar entity. So I felt I couldn't just talk about the three without talking about a few other things that might affect you. This might possibly affect you. It's a clarification which came about because as a result of some consolidation guidance, they needed this clarification. Statement of cash flows, there's been something that just came out about restricted cash. There's a slight divergence in policy, in practical application of some non-profits present their statement of cash flows with restricted cash and some leave it out, and there's divergence, and this tells you that you have to leave it in. Inventory, we're all familiar with the phrase lower of cost or market, LCM. Market is now NRV, so it's lower cost or net realizable value. It's honestly, it's designed to be a simplification, to be quite honest, and that is coming out. And then the going concern one. Now, this was effective for the December 17, the December 16, but for the you junior ends, that might be June 30th of 17. So all it is if you've got some signs that you're struggling, then please don't be offended if your auditors ask you for a memo as to why you're going to continue as a going concern. Previously, all of that going concern guidance was put on the shoulders of the auditors, and now it's been put within GAAP and put on your shoulders to assess whether you have any kind of going concern issues, and then it's up to the auditors to concur, which again is the right way to do things. It probably should have been that way all along, but it wasn't, and it was a struggle for us auditors, and now it's you decide and then we concur. So I wanted to mention all of that. There's a bunch of resources, including the AICPA has a non-for-profit section, and there's a whole bunch of stuff on BDO because we do so many non-profits. We have blogs and all those other kind of things. And so I included all of that for you. And I don't know how we're doing for time with questions, but like I said, I will, if anybody wants to submit questions to me through an email, I will answer them as long as they're easy. If they're hard, I'll send someone else. And but I'll refer them to the local office. And but are there any questions here in the room, or anybody online with a quick question? Hearing none. Well, I've enjoyed this. Thank you very much.